Peter Lynch said 2 quotes. He says, if you can't handle losing 30 to 50% of your stock's value, then investing might not be for you. You should look at that from time to time because it's easy to forget oh yeah, that's a possibility.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with John.
Good morning.
And Isaac.
Hello.
And we're excited to be here.
Yeah, absolutely.
So 2 main topics we want to get in today. Timely, relevant, and I think good topics. We've had some volatility in the markets. Markets kind of come back from the Iran war, conflict sell-off. Wasn't much of a sell-off, but a little bit of a pullback. Mm-hmm. Kind of gained that back here recently. But, a common question, something that we've seen coming up recently is how do I protect against, sequence of return risk if I'm right here at retirement, whether it's now or in the future, and the market's getting volatile and there's a lot of risk and concerns, and how do I protect against that if I'm retiring in the next couple of years or just recently retired? So if someone asks you about what is sequence of return risk, maybe we start there. Isaac, you want to define that for us?
Yeah, absolutely. So I think I put the chart up before. I may put a chart on the screen if we can do that. But sequence of return risk is the risk of when the returns happen given the years. So the chart that I'll put up is it's starting the same amount of starting value, average 8% return during working years. So you're not withdrawing from it. As long as you're averaging 8%, it's going to end the same, right? When you start to withdraw, you can average the same return, but if the bad years happen first, on this chart you'll see you run out of money. Yeah. And if the good years happen first, you actually die with $3 million or something. It's one of my favorite things to pull up to bring up sequence of return. Yeah. For people, especially the past, as John always talks about, 15 years of great market. It's we're kind of oblivious to, it'll just bounce right back, right? And so it's a good chart to show if it doesn't, yeah, for longer than 6 months, right. Yep. There's a chance that it makes the dollars you have still invested weaker, and so they have to perform even harder to meet your goals
to get back to
right.
Yeah, yeah. If you're taking money out,
yeah.
John.
No, it's perfect. Examples: 2008. Those who retired in 2007, 2008 had a terrible sequence of returns. Right, they retired. If they were invested fully in the market, retired 2007, market went down 54% in a year and a half. There goes your entire retirement plan, right? Mm-hmm. People went back to work. It was actually pretty big issue back then, right? Mm-hmm. Now, you can avoid that.
Sure.
And there's lots of ways to avoid it. So I was thinking what if today was the start of the 2008 returns? What if the next year and a half was the same? We were down 54% from today till 15 months from now. Would you be set up right? And I was thinking, if you're in retirement or close to retirement, you need to be aware that can happen to you. And then it's about how you diversify your portfolio, how you're protecting assets, either using some type of protection buffer. I don't know.
There's a million ways to do it. But just protecting your assets. The other thing that I think even for younger folks like you two whippersnappers, when you have a great market like we've had this wonderful run of a market. And I just kind of find it interesting because yesterday there was some oil news and the war's back on, so to speak, right? And the Strait of Hormuz is still in trouble and all that stuff. And I thought, man, this is going to be a bad market day, just right back to where we were. And it wasn't. Market's resilient. And we've been resilient for a long time. This market, even with a few little blips here and there, the market's been resilient. There will be a reversion to the mean at some point. Mm-hmm. If the S&P averages 11% a year forever, and we've been averaging double that for the last 10 plus years, there is a reversion back to the mean at some point, which means you'll have lower returns at some point to get it back to. Yeah, and that could come in multiple ways. It could come in the form of a major pullback. Yep. It could come in the form of just underperformance for a longer extended period of time, right? And both of those have different kind of outcomes based on if you're in retirement, how do you weather through that? Weathering through a 1 or 2 year severe pullback is different than weathering through a 10 to 15 year period of
just slower returns.
Just slower returns.
Yeah, which you can you can manage both those differently.
Yeah. I would say, though, one thing that is massively important, and you brought this up in one of our meetings we just had recently as our advisor group. So smart. We've had this wonderful run. Make sure your portfolios are balanced the way they're supposed to be.
Yeah.
If you're a moderate investor and the markets have done so well, so your equity piece of it has now pushed you to where you're a moderate aggressive just by the fact of your balance, right? Maybe sell some stuff. Like get in the habit of like keeping that in your what you're.
We're doing
to
a review of that for clients kind of right now, going through that to make sure everybody's.
And that protects you from this massive short-term downturn, especially when you're close to retirement.
Yeah, and we've done episodes on it before, so we won't dive into it. But like their withdrawal strategy is really all this is.
Yeah,
is like how are you.
Where's your income coming
from? Buffer your income for the first couple years of retirement.
Because I'm a huge pull. If you have cash or other sources of income where you can take your income and not have to
worry about it.
Draw it, then it's like a really bad 1 or 2 year stretch maybe isn't that impactful, right? If you have income coming from rental properties and Social Security and pensions and annuities and wherever it may be, then maybe you can weather that. But if you can't, if you are invested, especially if you're invested maybe on the higher end of where you should be,
right,
and you don't have capital set aside to withdraw from or sources of income, then it can be devastating. I mean, it can be, hey, we're retiring to, no, we're not.
No, we're not. We're going to go back to work, whatever.
So a lot of different ways. Secrets of return risk is massive. We'll definitely throw the chart and have a link for, the data that Isaac was referencing, because when it comes to retirement, especially in those early years, most people get more conservative the older they get. Like you're more conservative when you're 85 than you were at 65. Yeah. The reality of it from an investing perspective is you should be more aggressive when you're 85 than when you're 65, right? When you first are retiring, I tell clients, we've talked about it 10 times on this show, but like the retirement red zone of 5 years before retirement, 5 years after, if there was ever a time around or through your retirement, horizon that you should be more conservative, it's that window.
Yeah.
Because you're retiring, your time horizon in life expectancy is the longest it'll ever be.
Exactly.
Right? And you can actually afford to deal with more volatility the older you get, with assumptions, right?
Yeah.
Because your time horizon is so much shorter. Right. And so most people don't think like that, but that is what that's what the analysis says. So you need to know that, like going into retirement, when you're in that kind of window, a few years before, a few years after, you need to be just cautious about not taking too much risk and making sure you have your emergency fund and your sources of income and where it's all going to be coming from.
And the money you have at risk, you need to be able to say, hey, if it goes down 50%, I can write it out.
Yeah.
Right? Because going back to
change lifestyle.
Yeah, 2009, those who had to get out because they were spending that money down while it was going down 54%, and they lost it all. So, if only a portion of if 50% of their assets were in the market taking that 50% loss, and they were able to live on, to your point, they had other ways to make money, and they could let that alone and let it heal, which it obviously did. Just a side note, S&P 500 or Dow 6400 in March of 2009, close to 50,000, or did hit 50,000 as the all-time high just a couple months ago. You wanted to be part of that recovery, right? So if you're out, even if you're in the market, it's okay if some of it, you just have to be able to have the time frame on that money to write it out.
Right. Yeah, have a purpose for your dollars.
Yeah, have a purpose for your dollars.
And couple Peter Lynch quotes. I couldn't remember them exactly, so I looked them up. There's two that I think is just good reminders. And all of this said, this sounds kind of like super pessimistic, I guess, of like what we're. But it's, I mean, depending on how this Iran conflict comes out or kind of settles out, shakes out. This year, 2026, could end up setting up as a good year. I mean, earnings have been strong. We've had a little bit of a healthy pullback. So it's not like we're negative on the markets right now.
Right.
So that being said, I'm going to say some scary quotes. But Peter Lynch said two quotes. He says, if you can't handle losing 30 to 50% of your stock's value, then investing might not be for you. You should look at that from time to time, because it's easy to forget, like, oh yeah, that's a possibility. And then another one is markets go down. Sometimes they go down a lot. If you're not ready for this, you shouldn't own stocks. And so it's just a reminder, like, you should have the money that you are comfortable with that, like if you read that and you're immediately like, oh snap, that's like maybe you own too much stocks. Maybe we should have some money outside of that in different buckets.
That's kind of like I was going to take up boxing one time until I found out somebody was going to hit me.
Yeah.
And then I was like, nope, not going to do that.
Great analogy. Yeah, I'm really glad you threw that in there. So anyway, sequence of return risk, really big deal, very important if you're on the cusp of retirement or thinking about it or just recently retired. Even if you're on the other side of it, but your life expectancy, your time horizon is still quite long, making sure you have a plan for that.
It's a good time to review your allocation when the market's up.
Yes. I mean, we're near all-time 100%. Highs, and so like now is a phenomenal time
to
say,
look at it.
Are we right where we need to be, or should we take some risk off the table?
Yeah. This is the perfect time.
Okay, second question. This could go a million different directions, but we're going to try to stay honed in on. So one of the hot topics, this has been over the last year or two, where I feel like, advisors that we talk to or we see at conferences or conferences in general are just, this is what a lot of it's been about. Clients have started asking about it. Then we've seen some of the headlines with Blue Owl and Ares, and some of these companies are struggling. But it's the whole conversation around private credit. And, should I invest as an investor? Should I invest in private credit? What is private credit? And then we're going to kind of tie into that, private equity and how that fits into the portfolios. And are the risks, the pros and cons worth the potential, benefits that those markets give you? So private credit, right? For those of you who don't know, most of you probably know, private credit is just, someone is lending a private company, a company that's not publicly traded, money. So this
typically
is
not a bank.
Not a bank, yeah, like private lenders.
Private
so
lenders,
like family offices or institutions or whatever, and they're lending SpaceX or Anthropic or a lot of these big AI companies have been borrowing money, and they're lending to companies, and there's been a lot of concern around, are these companies, especially in the software space, are these companies going to be able to pay this money back?
Right.
So in private credit, you typically get slightly outsized returns because you're taking more risk, because there's lockup periods. There's, lack of liquidity. There's a lot that you don't know.
Yep.
It's kind of for a lot of investors, the individual investors, it's like a black hole. I mean, unless you just go and dig and do your research, which most no one does.
Yeah.
It's
hard to, by the way.
Yeah,
too.
like
it's hard to uncover.
It's kind of a black hole. Potential upside's pretty decent, but the downside is what we've seen here recently, like companies, if they need to, they can start really restricting liquidity even above and beyond the already restricted liquidity options that you have. So that was a lot.
Yeah.
If you think of the average investor, client comes in, $1 million, $2 million, hey, I've worked hard, maxed out my 401k for 30, 40 years, is that someone, I say the average investor, that's obviously above the average American portfolio, but just a lot of the clients we work with, are those clients, should those people look at private credit as a good investment solution for their portfolio?
Tiny, small doses, if anything.
Yeah.
Like maybe a small piece of the pie, 5% or less of your portfolio, or 2%.
Yeah.
But it is, there's a lot of pitfalls there, like you said. Anyway.
Yeah, I was just going to say, the more I dig into it, the more I just need to see more, like before I would make a suggestion to put something in it.
You need to know more about the specifics.
I need to know more about it because it's almost like it was so lucrative for so long. We don't know what the underwriting looked like for any of them. And that's the hard part about
it's definitely
giving access
looser
to
underwriting.
Looser underwriting, higher interest rates.
Yeah.
And then you get this kind of, the only thing in the market right now that seems to not be working is software, which is one of the things that got the most lending. And so it's like, when you go out and you buy a private credit fund, did you buy Oracle or did you buy this guy in his garage? Or, you know what I mean?
Yep.
And there's just not a lot to know. They also, one of my biggest complaints about it is the kind of manager sets the price. So like if you look at the book, it doesn't work because it's not publicly traded. There's no market to price it.
Right.
So it's hard to know if it's performing well, if it's not.
Which At times that can be a
good.
positive.
It could be a positive.
Because you're not going to make a knee-jerk reaction because, one, you can't because it's locked up. And two, it's like the price isn't going to move around like a public.
This is a tangent, but that's always been my argument about why people love real estate. It's because they don't get to watch the price of their house move up and down.
Yeah.
And they're like, it always goes up. And it's like, well,
and
you just can't watch it.
Yeah,
anyway,
I've used that. Like, you wouldn't sell your house if the price dropped all of a sudden.
Right.
Like,
but that's a different story. But that's kind of my thing is like, it's just not having all the details, the transparency of it is just something that would make me very hesitant as a retail investor.
So I think we just a minute ago I mentioned like have purpose for each dollar, right? Mm-hmm. And I think a lot of people that over the last year or two that have gotten into this space have gotten into it because it sounds cool, not because they actually need it.
Yeah.
Yeah.
Like, if you're going to make a 2 to 5% allocation for the average American retiree, is the potential 2, 3, 4, 5% alpha that you think you might get on that going to change the outcome of your retirement? And I would say for 100% of the people, probably not.
Yeah.
I mean,
if you have 100 million and you can put 2 million into this, you might make a difference.
Yeah, like it might move the needle.
Yeah.
But for most people, it's not that you should or shouldn't. It's just, why are you doing it?
Yeah.
Because these companies, what you have to remind yourself, a lot of these big companies, good companies. I'm not bashing Ares or Blue Owl or
Blackstone,
Apollo, all these companies. They're running a business.
Yep.
Mm-hmm.
Private markets, private credit have been a hot topic for a while now.
Yeah.
So there's been so much new money coming to the market. Coming to them saying, hey, we want access. They're running a business. They're not going to say no.
Nope.
Right? So to your point on underwriting, like, they're going to say yes. They're going to take the money and say, okay, now we have the money. Now we have to go figure out where do we put it. Like, we have to put it to work. And so I've always said in the private markets in general, the bigger is not better.
No, because you're taking more risk.
The more money they get, the more they have a mandate to go put that money to work. If they want to keep it and charge a management fee, they're going to have to put that money to work. And they're naturally, you're not going to have the same great opportunities coming to you at 10, 100x scale as you would. You're having to kind of do things a little bit different.
You're taking more chances to get the money.
Yeah.
Because all the good ones are
so
already,
I think
they're not borrowing.
Yeah, exactly.
So I've said for years, like, in the private markets, bigger's not better. Doesn't mean that there aren't good options in some of those players, but know what you're getting into. Maybe be open to looking at a smaller player in the space because maybe they only have, $500 million to put to work, and that's a lot easier to go find $500 million of really good, strong opportunities than it is $500 billion.
Exactly.
And all of the same. I mean, very different, but a lot of the same could be said in private equity. Not apples to apples by any means, but just know what you're getting into. There are pros and cons. The upside can be massive in private equity, obviously. But, you just got to make sure you know what you're getting into. And most people, if you're not in a position to allocate a sizable enough amount of your portfolio to really move the needle, my opinion would be, like, why do it at all, right?
Yeah.
If your net worth is to the point where you can make a sizable investment, and if it doesn't go well, you're still more than okay. Then, okay, let's have a conversation and see where this fits.
Private credit versus private equity. I know, like, private equity, we're going to talk a little bit about that, but just remember, like, these are illiquid for a time frame. Private credit usually is illiquid for less. So if you do private equity, you not only, small piece of the pie, but also money that you're just, I always kind of say, if you're willing to put that money in there, then it's just, you're waving bye to it.
Yeah.
And it might come back to you in 12 years with a nice
The hard part
but
with
you
private,
have to be okay with it.
The hard part with private equity, though, is like companies haven't, because there's been so much private capital on the credit side, companies haven't had the need to IPO as soon.
Right.
So to get access to some of these really high quality companies, like, you have to go to the private equity side. And so it's almost like a two-edged sword. It's like if there was less credit available, then some of these equity opportunities would be available in the public markets, which would be great, kind of going back 20 years ago, but they're not. So we're not saying, like, don't look at look at this stuff, because if that trend continues, private equity space might be where you get your 100 baggers.
Well,
right?
another thing, we do get questions about this of private equity, and there's limits. You know, you have to hit certain things before you can even invest it. You can't come in and say, I want to put $5,000 in.
Right.
Right.
You know,
Which that's slowly changing, though. They're
It is
starting
getting
to
easier.
make it easier and easier. And there's been talk about, hey, do we put this in 401k plans, right? Which is just all lobbyist money. I mean, it's just
right.
the right people with the right money are pushing for that.
Yeah.
But
You can get it through ETFs now. Like the big hot one. What's the hot name coming up?
They're coming out right now.
Yeah.
SpaceX.
Yeah. You could get that actually through ETFs. You could not do that 20 years ago.
Yeah.
You couldn't get access to that before it IPO'd through, other than through private equity or, by owning it that way. Now you can.
And it's so big in 4 months, it's going to be in every ETF anyways.
yeah, you're going to own it.
You're going to own it.
You're going to own it at some point. Yeah.
And yeah, the market's just shifted a lot because 20 years ago, 30 years ago, SpaceX, like that kind of company would have IPO'd years ago.
Yeah.
Because they would have needed to for access to capital,
exactly.
get.
Yeah.
And these companies are staying private for so long that SpaceX is gonna IPO at a $1.5 to $2 trillion valuation.
I think that's an interesting point because me and John go back and forth sometimes about like small cap, and it's one of these. This is a good story of like why small cap has underperformed recently.
Yeah.
Is because there's no small cap IPOs.
Yeah.
They're coming to market at $500 billion or $1 trillion and just skipping the Russell altogether.
The best small caps are just still private.
Yeah.
And then they IPO at mega caps.
And then they IPO at $2 trillion.
Exactly. That's not normal, but it's.
No.
SpaceX is going to be massive. It's going to set the record.
Yeah. So private credit, private equity, really interesting conversation. Something that we've explored, that we're continuing to explore, that we've dabbled in. But I just think you have to be cautious. If everyone's talking about it, both on the client side and the advisor side, typically it like turns me away of like, well, maybe now's not the best time to really dig in and look at allocating to this in a big way. But there's definitely opportunities. I mean, the risk is higher, the liquidity is lower, because the opportunity is there. Just be cautious. Know what you're getting into.
Yeah.
So
exactly.
Any parting thoughts or words? We talked about sequence of return risk, private markets. A couple good conversations.
I think these are great, wildly different conversations. I love them though.
Yeah.
It's important. I think Isaac hit it on the head. We said this is a perfect time to reevaluate your portfolio, your situation, on your retirement goals, all that kind of stuff, because we are at these elevated levels. This is a great time to really visit with an advisor, get a plan going.
Yeah, for sure. All right. Well, as always, we appreciate you guys. Give us a like, subscribe, shoot us an email, leave us a comment. We always love seeing those and love to answer any questions that you have. We'll look forward to seeing you guys next week. Take care.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.